Point number 3, what happens to your premium in an index universal life or IUL? So let's say that you have your premiums that come into your policy. For this example, let's assume that you pay $100. In general, in IUL product, there will be a fee that will be deducted from the premium that you pay. That fee is usually called the premium load. And depending on the company you work with and the product, that fee can change. So in this example, let's assume that that fee is going to be 4%, which means in our case, $4. So after deducting the premium load, you'll be left with $96. That represents the net premium. This net premium is now what is going to be put into some vehicle to earn interest. We're not talking about what vehicle at this point or how you earn interest. Let's just assume that you earn interest. And whatever is earned is going to go into the accumulated value. Let's put it in a box like this. And let's put an arrow here. Now you, the policy owner, you stand right here. And you can access the accumulated value through two different means. The first one is through a withdrawal, and the second way is through a loan. So the withdrawal is just basically like what you do with your bank account. You just go and take the money out. The loan is different. With the loan, you don't touch your accumulated value. You take some money from the insurance company. So they loan you the money that you want, and they use your accumulated value as a collateral. On the other side here, you have deductions. And among these deductions, you have the cost of insurance, COI. For instance, after a couple of years, if you want to cancel the policy, you'll have surrender charges. So basically, if you want to cancel the policy, you will get whatever is the accumulated value minus the surrender charge. You could also have some other administrative fees. Okay, we will not go deeper into that. If you've been following this series, probably you notice that it always comes down to the cost that we pay into these policies. And a good design, by good design, I mean a design that helps maximizing the cash accumulation and keep a healthy growth of the death benefit, will basically try to minimize all the deductions, all the fees that you pay in a policy. It's very important. And why? Because the less you pay in fees, the more money you can keep here. And this money that you keep here, guess what is going to happen to that? That money is going to keep earning interest and compounding over time. So basically what you'll see, if we draw a little diagram here over time, and here accumulated value, you'll have something like this, then it grows, and so on. Furthermore, why is it important to minimize the fees that you pay in a policy? Let's say that you earn 10%. What you don't want is to have, let's say, fees that eat up 6%, for instance. And then you end up actually having a net return of 4%. But on the other side, if the policy is well designed, and let's say that, and you just make 7%. If out of that 7%, you only pay fees for 1%, you see that you still make 6%, which is better than the 4%. So the success of a policy highly depends on the design. In the next episode, we'll talk about how much premium you can pay per year in a policy. Stay tuned.